Hi, welcome to my channel. We're starting a new video presentation for finance. This is the introductory video for financial management. Let's start with what is finance, how finance is defined, what are the objectives, scope, and how financial management helps a firm's management, board of directors, financial directors manage the day-to-day finances and long-term objectives of meeting the firm's overall mission and vision statements. Let's start with the firm's objectives. Every company and every firm is led by the management, the board of directors, the chief economic officers, the CEOs, or the chairman. A firm's management must develop a very clear idea about what the purpose of the firm's shareholders are, what are the key objectives. The mission of a firm's shareholders, the investors, is to deliver economic value for the owners of the firm, to increase growth, increase profitability, increase firm's dividend payments. Also, the board of directors shall keep in mind while undertaking decisions that the most important thing in the business is to bring maximization of benefits for the firm's shareholders, who are the real owners of that business. The objectives, strategies, and decisions made by the board of directors should be directed towards creating value. Value can be created through sales maximization, profit maximization, one of the challenges which is faced by a firm, the board of directors, is to make investments at the right places, to find the best projects where investment can be made so that it provides the highest return to the shareholders. For example, if the market rate of return is equal to 10%, and the firm's board of directors are considering project A, which is expected to provide a return of 13%. That means project A has a return which is in excess of minimum return required. So this means more profits, more value can be created for the firm shareholders. So the primary objective of the board of directors is to find such projects whose returns, whose yields are greater than market returns. So in this context of a firm's objectives, what is finance? What is finance function? Finance function can be broadly defined as the activity which is concerned with planning, raising, controlling, and administrating the funds. Planning how much funds is required, raising the funds from required sources. Funds have sources like issuing equity, issuing debts, loans, issuing bonds. So the firm's finance director has to decide which source the capital should be raised, controlling the investment process, controlling the whole amount of spending the funds, administration of the funds so that wastages can be minimized, cost can be minimized. If cost is minimized and sales are maximized, profit can be maximized, wealth can be maximized. Corporate finance can also be defined as budgeting, financial forecasting, management of cash, credit administration, investment of long-term projects. And procuring these funds required for the business concern. I would like to provide a note that investment is basically a long-term objective. These decisions cannot be reversed. Once you start investing in a project which has a 10, 15, 20 years of life, the project cannot be reversed. If you reverse the project, if you stop funding the project, there will be losses. The funds which has already been put into the project will be lost. So carefully, the finance director, the board of directors has to take a decision whether they need to invest in a particular project or not, because they know fully well once an investing decision is undertaken, the decision cannot be taken back. It cannot be reversed. The finance function, how the financing thing, how decision making, and where the responsibility of finance and financial function lies. You can see the finance director is sometimes also called a chief financial officer. The responsibility is to stimulate the strategies and financial policies are made. The chief financial officer or the financial director works in close collaboration with the CEO and the board of directors. He's a top manager, so his job is making policies. Below him, two types of job functions are there. One is the controller or the chief accountant, the other is the treasurer or the financial manager. The responsibility of the controller is keeping track of financial accounts, management accounts, appraising the projects, managing taxes. Finance manager or the treasurer is more concerned with managing risk related to projects, funding decisions, management of cash, relationship with bankers, merger and takeover decisions, etc. So this is basically an accounting function. This is basically the primary finance function. Both the controller and the treasurer report to the finance director, which reports to the CEO and the board of directors. So throughout financial management subject, the treasurer is going to be the primary person possible responsible for undertaking decisions regarding how to select projects, how to select the sources of funding for the projects, managing cash, managing accounts receivables, etc. The primary objectives of financial management are profit maximization and wealth maximization. Profit maximization is an old concept, but it is an important concept because this provides incentive to make as much profit as possible. So the ultimate objective of profit maximization function is to earn profit. So the financial manager must undertake all the possible steps to increase profitability of the concern. That includes maximizing the sales, minimizing the cost, minimizing expenses, etc. Profitability, however, is a narrow concept of providing value. Profitability minimizes cost, so it increases the possibility of reducing risk, reducing cost. But on the other hand, wealth maximization is about creating value. Is about creating value. The term wealth means creating wealth for the shareholders. That means increasing stock prices so that the value of the firm is maximized. When stock price increases, that means stock price, market price of share. When it increases the returns for the shareholders. This is an universally accepted concept which provides a long-term return to the shareholders, to the investors. Wealth maximization is considered as superior to profit maximization because the aim of the business is to improve the value and not just improve profits. Wealth maximization considers time and risk, which is going to be one of the most important concepts in financial risk management. Wealth maximization leads to efficient allocation of all resources available, and we know that resources are always limited. So if you are able to allocate resources very skillfully, you can create immense wealth with limited amount of resources. Wealth maximization also ensures that the society is benefited too. If a firm is creating higher value, it will look at corporate social responsibility, it will keep investing in health, it will keep investing in education, it will provide more wages to the employees, provide more in taxes to the government. So wealth maximization as an objective of financial management is a more prudent objective than just profit maximization. What are the primary purposes of finance function? Three functions, as we can see: investment, financing, dividend. The investment function is basically about where should we invest, because the long-term funds must be put into the best possible use. The management should make careful assessment of various projects through methodologies such as capital budgeting. Capital budgeting we will study later, we'll discuss them. So the management needs to undertake a thorough measurement of various projects before undertaking a decision as to where the funds shall be invested. Also, a part of the total funds must be kept towards meeting daily working capital management requirements. The management should be concerned with investing because funds, if lying unused, won't provide any returns. So all the funds needs to be maximized as investments. So investing is a primary purpose of financial management. Investment in current assets, investment in long-term assets, investment in human resource management, investment in production, investment in inventory. So all these decisions has to be coordinated with available funds, and if funds are in short supply, funding decisions needs to be made. Financing decisions are about funding. If you have a project in mind whose return is 13% and your required return is equal to 10%, you know as a finance manager that this project is highly beneficial for the firm in creating value because it provides more returns to the shareholders. But you don't have enough funds to invest in such a large project. So where should you get the funds? Whether you should issue equity, issue bonds, issue debts, provide, take a decision regarding taking a loan, etc. So the financial manager must undertake a decision regarding how to finance a project, optimize the capital structure of the firm. Financing decision also needs the fiscal manager, the financial manager, to have a good knowledge of evaluating risk. If you undertake excessive debt, this means that is maximum risk for shareholders, which they don't like. So you have to keep a balance between debt and equity. Too much debt might be harmful for valuation of the firm. So financing decisions has to be delicate, keeping in mind the long-term objective of value maximization, wealth maximization, and minimizing the risk at the same time. The third is dividend decision. How much dividend should be paid? How much dividend should be paid in cash? If a stock dividend has to be paid. The dividend decision is usually undertaken by the board of directors with practical inputs from finance manager regarding how much of the profit after taxes shall be distributed as profit to the shareholders. One must remember that a regular and growing dividend is desired by the shareholders, and many firms keep paying regular dividends. But some firms might not be able to pay dividends because they are growing firms, they need to invest in new projects. So there has to be a balance. Dividend decisions are decisions which will increase wealth, increase stock prices. So they have to be undertaken very carefully. Functions of financial manager. We have already discussed it in the definition stage, that forecasting of the requirement, budgeting. The finance manager needs to undertake budgeting to know how much expenditure he is going to make in a year or in a 5-year period, and how much funds he will have from internal sources, so that he knows in advance how much external funds are required. External funds can be generated from bonds, issue of equity, etc. Once the funding requirements are necessary from forecasting, you need to make arrangement for acquiring the capital by issuing stocks. or by issuing bonds, by undertaking a loan from a bank. Then you need to decide where you should invest so that yields or returns are maximized. Investment decisions must be taken by keeping in mind the safety of the capital, liquidity, how soon cash can be generated from the project, and how much profitable the project is. Safety, liquidity, and profitability are primary concerns while undertaking investment decisions. The next thing is management of cash. A certain amount of cash shall always be maintained by a firm to able to meet day-to-day routine transactions. Paying of accounts payable, payment of creditors, payment of wages, payment of taxes. So cash management is of important concern to the managers. The financial manager also required to keep a very cordial relationship with all the other functional departments such as marketing, production, research and development, and sales, etc. So he must have adequate cordial relationship and he must possess sound knowledge about these core functions of the business. Thank you so much. We have discussed the introduction things. In the next video, we'll start discussing about time value of money. Till then, kindly subscribe to the channel. You can also email me. You can also WhatsApp. Thank you so much. Please subscribe to the channel. Till the next time. Bye-bye.